Good morning, good afternoon, good evening to you all, wherever you are around the globe. And welcome from me again, but this time to the second session of our 2022 Shipowners webinar series, Riding the Wave, Staying the Course. My name is Christian Finnern. I'm a maritime partner based in our Hamburg office, which I'm heading. I'm also leading our German corporate services group, which has, together with our global team, a strong focus on the transport and energy sectors, but also beyond, advising our clients across the range of maritime law, corporate law, employment law, and regulatory affairs, as well as on tax matters and dispute resolution. As a co-head of the firm's global ship owners group, we are all very pleased, but I'm personally too, to once again welcome you to a series of webinars on subjects which we believe are key to the immediate and long-term interest of those operating in the maritime sector. Last week, some of you could attend at the first session. My colleagues Valentina Keys and Nick Walker were so kind to deal for us with challenges in environmental compliance, ship recycling, and European Union ETS, addressing two particularly pressing issues within the wider context of ESG. They explained to us how industry players' business is to be in compliance with these important but sometimes challenging regulations. For those of you who missed it, it was recorded. It will be published on the WFW YouTube channel, WFW LLP, in due course. Now turning to today with a thank you to all of you for making it. Our session today is about global tax reform, the future of shipping taxation. We will hear in the next hour from some of the leading voices on taxation in the shipping sector, discussing what lies ahead in relation to taxes and taxation in maritime. These voices include my partner, Richard Stevens, from our London office, and my partner, Danny Pilarski, from New York. They will be expertly moderated by my partner, Verena Scheibe, based here in Hamburg. Verena is a tax partner in the tax team and specializes in tax matters relating to mergers, acquisitions, private equity and joint venture transactions, with an emphasis on national and cross-border tax structuring, tax due diligence, as well as tax advice on any transaction document, buy side and sell side. Verena has worked on transactions and restructurings across a broad range of our core sectors, such as maritime, aviation, renewable energy infrastructure, and real estate. For funds like PE funds, alternative investments, institutional investors, financial institutions, family offices, and many others. Daniel is a partner in the tax and regulatory groups. His practice focuses on US tax aspects of cross-border transactions, as well as US trade sanctions. His experience includes structuring transactions to achieve the best results of his clients, addressing anti-deferral regimes, and mostly also with withholding tax relevance. Then he advises regarding Foreign Account Tax Compliance Act, FATCA, you all know how, I guess, both in compliance and in documenting provisions in loan and other agreements. Additionally, Danny helps clients analyze the US freight tax on shipping income and the exemption from tax. In addition, very important these days, Daniel's focused on sanctions, where he is currently faced with a high demand on his advice, includes clients in understanding and complying with the rules and regulations of the Treasury's Office of Foreign Assets Control, OFAC. My partner Richard is, as said, based in London and also a partner of our global tax group. He advises UK and multinational companies on all aspects of UK corporation tax, with a clear focus on maritime, energy, and real estate. Richard acts for a number of banks and international shipping clients in relation to the financing of maritime assets, and has a particular interest in the UK's tonnage tax regime. He is a member of the UK Chamber of Shipping, Tax and Economics Committee and a member of the Industry Advisory Group for the UK Government's Maritime Growth Study. Also today, this session will be recorded and will be published in due course on our YouTube channel, WFWLLP. We will also circulate the links to the 3 webinars at the conclusion of the series. Speaking on the series, the third and final webinar will be about employment issues in maritime. Again, very interesting, important topic of these days about crewing, works councils, and beyond. It will take place on Wednesday, 29th of June, so allowing a few days of break for President. If you have not done so, feel encouraged to make your bookings also for that event. You can do so by the original invitation, but we will also circulate a reminder going closer to that time. Before I hand over to Verena to begin the discussion, may I quickly mention that you have, of course, the opportunity to raise your questions, and which we're happy to take at the end. So please use the Q&A button on the Zoom, use that function, and Richard, Daniel, and Verena will take those going forward. Again, thank you very much for your time of joining us today. And I'm now happy to hand over to Verena to start and kick off with the discussion.
Thank you very much, Christian, for that kind introduction. I may also say some introductory words because they are important to follow. They may be important to follow. Today we will speak about the global approach to shipping taxation, or the trend to such a global approach, and we will use various phrases that are only meaningful to tax people. And I may shortly explain these to you. The main ones are BEPS and the globe rules, and these phrases, they actually show how important the brain game has become in our tax world. And the background of these phrases is that politicians, they had to meet, they had to come together to agree on global tax rules. So they had to come up with new words for different ideas. And BEPS, and you will hear that word very often today, just means base erosion and profit shifting. And that is acknowledging that companies might move to another jurisdiction, and they might account for their profits in low tax countries. So BEPS is just a brand name for globally agreed anti-tax avoidance measures. And these have been implemented and agreed on by the OECD member states. It's a project since 2013, is a very successful project, and definitely is sort of acknowledged as a good thing and worthy of support. The second phrase is globe, or the globe rules, and that just means global anti-base erosion. That is an even more ambitious project, but is also just a cool sounding name for a set of global anti-tax avoidance measures. So that as a background, what are we going to discuss today? First, my dear fellow colleague Richard will speak generally about the history of shipping taxation, including the race to the bottom, and further he will give an overview on the relevant global tax rules, with a focus on, as I said, BEPS and the globe rules, and what these will mean for the future of the shipping industry. And it's my pleasure to hand over to Richard. Please, Richard, start your presentation.
Thank you, Verena. As Verena just mentioned, I'm going to speak for about 15 or 20 minutes on some really quite complicated topics, but my aim today isn't to teach you everything you need to know about the GLOBE rules or the BEPS rules. I really want to give you some context and a very basic understanding of what is happening in the world of global tax reform, really with an aim that if you find yourselves in a conversation about a global minimum effective tax rate, you've got something to fall back on, so you know what people are talking about. If we can just move to the overview slide, Meryl, please. So how are we going to get there? Well, context is super important in this area. So we're going to do a very short history of shipping tax, explaining how tax policy has developed and what it is today. Within that, we're going to talk about this idea of the globalization of tax rules. So this is the idea that tax has moved away from a purely domestic issue to being one that is being attacked globally. That then brings us on to these GLOBE rules, which Verena just mentioned. And then very briefly at the end, we'll talk a little bit about what the future might hold. So if we can move to the next slide, Mel. So what I've found in giving these talks to various parties over the past few months is actually it's quite helpful to get straight in with what the global minimum tax rate is meant to do. So this slide just sets out a very simple group structure, and it shows how this idea of a global minimum tax rate is meant to work. So what you can see here is we've got two companies in our group. We've got a holding company in country A, and we've got a trading subsidiary in country B. So let's imagine TradeCo is our shipping company and it performs its activities in country B. Country B has decided, exercised its sovereign rights to declare that it's going to have a corporate tax rate of 5%. And in our tax year, the trading company has made a profit of 100. So it pays its tax of 5 to the government of country B. That's all very good. We live in a world now where the GLOBE rules have been applied, and country A has decided that it will implement this global minimum tax rate rule. So this is the interesting bit. The government of country A is able to say to Holdco, you have a subsidiary that hasn't paid an effective tax rate of 15%. And therefore you're going to pay to me, the government of country A top-up tax amount. In this instance, it's 10%. So the profits of TradeCo earned in country B are actually going to be taxed in country A, and the tax result is paid to the government of country A. So it's the holding company jurisdiction, which in theory at least gets the tax from this global minimum tax rate. We can go to the next slide now. So the rest of the slides now will build back up to explaining how we get to that point in the world, and indeed whether we're actually going to get there, because it's important to note there is still some significant doubt about whether these rules can actually come into force. But really what's trying to happen with these global rules, what they're trying to do is two things. One is to discourage tax competition between different countries, and also to limit the opportunities for people to divert their profits to low tax jurisdictions. The idea being simply if everyone has to have their profits taxed at 15% somewhere, there's no real incentive to move your profits to a zero tax jurisdiction, because you'll just pay a top-up tax somewhere else. And what you'll hear tax people talk about is the race to the bottom. Now, what does that mean? That's really this idea that two countries might compete with each other for business. And how do they do that? Well, they use their tax system, and they constantly undercut each other with their corporate tax rate until you get down to zero. Now, interestingly, for shipping, I've been working in shipping tax now for 20 years. And one line to describe global shipping tax policy is do not tax them and they will come. So various governments around the world have used this idea that we will lower tax rates and attract shipping businesses in that way. So you can see as a global industry, shipping has effectively won this race to the bottom. It is an industry, it enjoys a very low effective tax rate, and it's stayed there. And importantly, It's been allowed to stay there. So we can move to the next slide now, Mel, please. Now, how's that happened? How has shipping been able to get to the bottom of this race to the bottom? Well, we've got to go back in time. And if we start with international trade, the idea that took hold was that shipping companies should only be subject to tax in their home state. And that caught on because other countries realized that taxing foreign ships arriving in your ports didn't encourage trade. And importantly, the major shipping jurisdictions were able to exercise leverage over other countries to make sure that their shipping companies weren't subject to tax as they traveled around the world. You move on to the next slide, Mel. So what we have is the US and the UK predominantly encouraging tax-free shipping as ships sail around the world. And the US introduces the idea that they will exempt a country's ships from US taxation if you reciprocate. So if you don't tax US ships when they call in your ports, they won't tax them in your ports. And that idea really spread around the world. And we see it today in most double tax treaties. It's Article 8 of the double tax treaties that says that ships in international traffic should not be taxed outside of their home state. So they're not taxed as they travel around the world. Next slide, Mel, please. So we have a system now where shipping traffic is not taxed as it goes around the world. And in theory, at least, it's taxed only in its home state of the shipping company. But then in around the 1920s, shipping discovers registries of convenience, and it really becomes the first global industry to make use of tax havens. So you can now see you've got ships traveling around the world, which are not taxed in the ports they call into. And their home state has exercised its sovereign right to say, actually, we're not going to tax shipping of other companies. So the home state taxation is also zero. So you can see suddenly shipping's effective tax rate as an industry heads down towards zero. So what happens? How do you compete with a country which isn't taxing shipping businesses? So the UK, for example, how does it wants to keep a shipping industry? How does it do it? Well, the answer seems to have been that you had to adapt your tax system to fit in with the shipping model. And so what we saw in the EU is the introduction of tonnage tax systems, which creates a very low effective tax rate for shipping companies, so long as you contribute economically to the country in which you're based. That is effective tax competition. That is countries saying, set up in my country and we will give you the benefits of a low effective tax rate. Helpfully for the shipping industry, that was looked at by the EU and the OECD. And as we might imagine, they declared that that wasn't a harmful tax practice. It is okay for there to be shipping tax incentives. So tax competition within the shipping industry is okay. Now, why has that happened? Well, what you see from the OECD time and again is that the concept of no taxation or low taxation isn't in itself a cause for concern. What the OECD objects to is the artificial separation of income from the activity that generates it. The fact that it might not be taxed or a country might decide not to tax certain income is in and of itself okay. Next slide, please. We start the build up now to the global rules, and really what we started to see after the financial crisis was a real change in people's approach to tax avoidance. And that's where we see the start of the BEPS project in around 2013. And this is the idea that Verena mentioned before, that if you want to have an anti-avoidance rule, an easy way for a company to avoid that is simply to move to another country. Now, what if every country had the same anti-avoidance rule? You can sort of cut off that exit route. So the BEPS project was run by the OECD and it's been very successful. At about the same time, we saw the US introduce FATCA rules, which again is the US making use of taxpayers in other countries to effectively enforce US tax rules. So again, it's just another example of tax becoming a global issue rather than a purely domestic one. And really, for the first time, we found countries willing to dictate to other countries. So we had the EU, we have the OECD as an organization, telling countries what their tax rules should look like. Now, interestingly, but as a slight aside here, that attitude is now starting to spread out not only to governments, but to companies. So we're seeing in, for example, tenders, that companies are willing to ask people bidding for that work what their tax position looks like. And we're likely to see an increase in that sort of activity. So banks asking lenders, investors asking companies what their tax position looks like. Next slide, Mel, please. So then we get to the globe rules. And what this is, it's a huge, we shouldn't underestimate how ambitious a project this was, and still is. And what it is, it has two pillars to it. There's two parts to this project. The first one is to really re-examine where companies with global customers pay their tax bill. Now that's what we call Pillar 1, and it really is aimed at the very largest companies in the world. So that's companies with 20 billion euros of revenue. But it's redesigning where they pay their tax. And it's this idea that if you have customers in a jurisdiction, but you're not physically based there yourself, you should still pay tax in that jurisdiction. Now, we're not going to focus on that today because really there's very few, there are some, but there are very few shipping companies caught up within Pillar 1 simply because of the size of the company. Pillar 2 is much more interesting for shipping, and it's aimed at companies with revenues in excess of 750 million euros in a year. Now, that is still a pretty big shipping company, but there are a number of companies caught up within that. But interestingly, for those below that level, what these rules are doing is showing you a direction of travel in relation to tax policy. So even though you might not be within these globe rules just because of size, you can see that slowly the approach of governments to taxation is changing. And this is a wonderful example of the way we think the world is going to go. The main aspect of Pillar 2 is this global minimum effective tax rate of 15%, as we've discussed already. Next slide, Jamal. So again, this is just the same slide before. And then just to make that point again, the key issue that you need to get your head around here is that the taxing right is given to the holding company jurisdiction. So even though your profit might be realized in country B, and it is allowed to choose a low tax rate if it wants to, an additional taxing right is given to the holding company jurisdiction to top up the tax that perhaps ought to have been paid, so that everyone pays eventually an effective tax rate of 15%. So next slide, please, Mel. And this is really the key point at the moment, the timeline for these rules. It's important to say from the outset, the OECD as an organization constantly sets itself very ambitious deadlines. This whole project is ambitious, and the OECD has made it work. At each stage, it sets an ambitious deadline and it meets it. So the framework rules for this global tax reform were published in December 2021, just before Christmas, guidance published shortly afterwards. And the idea originally was that these rules would be in force around the world by the end of this year and be effective next year. The trouble is, at this point, once the framework rules are published, the OECD effectively relinquishes control of deadlines, and these rules have to be implemented in all the jurisdictions. And remember, the idea here is that they are implemented everywhere around the world. So sort of in excess of 130 countries are meant to implement these rules into their own tax system. Now, that is a hugely ambitious idea, and we are already starting to see problems. So the EU is a big supporter of these rules, but it has already pushed the deadline back to 2024. There was some more talk yesterday in Davos that the rules might be pushed back again. There's a huge issue in the US at the moment. So the Biden administration is a supporter of these rules. It wants these rules to be brought into force, but there's a huge question mark over whether there is sufficient support to implement this legislation in the US. Now, the US in particular, I think, causes a huge implementation risk for these rules everywhere else. And it's this idea that if you've got global tax rules, but the US hasn't done it, are they worth doing? And the final bullet point there, does a piecemeal, non-global minimum tax rate really stop tax competition? And there's a significant risk at the moment where countries have supported these rules in theory, but if they see the US doesn't do it, they can say, well, hold on, I'm not going to put myself at a disadvantage here by introducing these rules when they're not really global. I am a supporter of a global tax rule, but not a piecemeal one. And obviously, the more countries that say that, you'll have a domino effect that the rules effectively lose their intention. They're not stopping tax competition if everyone hasn't done it. So there is a huge risk at the moment with this timeline and whether people can implement. If we can go to the next slide now. So what do we know now? Well, when these rules were first introduced, obviously the idea of a 15% tax rate for shipping was bad news. That is it's not welcome within the shipping industry. And shipping pushed for a blanket industry exemption based on the idea that shipping tax policy was well set, it was established, people understood it. There wasn't really a problem within shipping to deal with. And originally that was accepted as an idea. But then when the rules came out, that wasn't quite what we got within the rules. The industry exemption is basically there, so international shipping income is outside of the global rules, but only where the shipping company has the strategic or commercial management of its ships in its home jurisdiction. Now, that term, strategic or commercial management, is effectively borrowed from the EU tonnage tax rules. But within the EU tonnage tax rules, it's a very ill-defined concept, deliberately so. Daniel will talk in a minute about the idea of being adequate in tax rules. It's a similar idea. So we're not really very clear what that idea means in the context of these global tax rules. Go to the next slide now. So where are we today and what does the future hold? Well, at the moment, the global rules exist as a framework, but they haven't been implemented anywhere. And there is a significant risk at the moment that the rules effectively fall apart or are just pushed back and back and back. And the global cooperation needed to effectively implement these rules is very fragile. And you really can see a position now where all the OECD's hard work falls apart somewhat. That might not happen, but you can see it's definitely sort of at a tipping point at the moment. And interestingly, what we're seeing with the various shipping companies we're speaking to is because of that risk of implementation, the implementation just not happening, is it would be a very brave shipping company that actually took real steps to restructure to deal with these rules when they might not come into force. So at the moment, the general approach of shipping businesses is to keep what we might call a watching brief over what's going to happen with these rules. So it's important to be aware of them and to perhaps have a think about what you might do, but no one is actually pulling the trigger and taking steps to change their structure. But what can we say, whatever happens with Globe? Well, we can say with a high degree of confidence that tax is not likely to slide back to being a private domestic issue. This idea that my tax position is none of your business has gone. We are very likely to see more global anti-avoidance measures because it just makes sense. If you're a high taxing jurisdiction, if you can get other countries to support you in your anti-avoidance measures, it cuts off that route out. So mobility doesn't become a defense. You can't threaten to go if you introduce a tax rule because wherever you go to has the same rule. We're also like to see much greater transparency around taxation. People are much more willing to ask what your tax position looks like. And we have organizations like the EU and the OECD who are perfectly willing to dictate to other countries what their tax position needs to be. I feel we're going to see an increase in borrowers being asked those questions by their banks and contractual counterparties asking again what their tax position looks like. And on that, I will hand back to Verena.
Thank you, Richard. That was really interesting. And I think it has been made clear that we will expect quite a change in taxation, shipping taxation. So connecting to that presentation, Daniel will dive a little deeper into economic substance rules which are already in place. So he will focus on the Marshall Islands economic substance rules, and further he will give an insight into US tax residence rules and their application for treaty purposes. And last but not least, Daniel will touch planning opportunities for Marshall Islands companies, especially from a US tax perspective. So I think we're all very much looking forward to your presentation, Daniel. Spot on, please go ahead.
As Richard just said, a big part of recent issues with international taxation are the new globe rules, the potential for minimum tax, and he mentioned several times the US being a major impediment. There's plenty to talk about there, but I'm actually not going to talk about that. Instead, as Verena said, I'm primarily going to talk about the already in effect Marshall Islands economic substance rules. And specifically, I'm going to focus on how they relate to the concept of tax residence, which is very relevant for purposes of international taxation. Next slide. So why were the Marshall Islands economic substance rules enacted? The first thing I would note is I'm going to be talking about the Marshall Islands, but the truth is these same or very similar economic substance rules apply to several countries traditionally thought of as tax haven jurisdictions. And they're aimed at a lot of the same types of things that the globe rules are aimed at, which is that parties shouldn't be able to form a country in a low tax jurisdiction or a tax haven jurisdiction without true economic substance relating to that jurisdiction, unless, of course, that company is a tax resident of some other jurisdiction that is actually imposing taxes. So that's the context behind the economic substance rules. I am focusing on the Marshall Islands just because that's it's one of the most common jurisdictions in use for shipping. It is worth mentioning that Liberia, another very common jurisdiction, does not have these rules. So none of these economic substance rules are applicable to Liberia. Liberian companies just do not have to comply with them. So when do the Marshall Islands economic substance rules apply? What are the circumstances that trigger them? Well, there are two key defined terms. They apply to a relevant entity that derives income from a relevant activity. So what is a relevant entity? It's generally a Marshall Islands entity, such as a corporation, partnership, LLC, etc., certain foreign registered entities operating in the Marshall Islands, unless that entity's business is centrally managed and controlled outside the Marshall Islands and it is tax resident outside the Marshall Islands. So the general rule is, if you have a Marshall Islands entity, you are a relevant entity unless you can say that you're a tax resident outside the Marshall Islands. Next slide. So that's relevant entities. The next question is, what is a relevant activity? Again, the rules are relevant when you have a relevant entity that earns income from a relevant activity. Well, there are 11 categories of relevant activities. Here, I'm going to focus on the main ones that are relevant for shipping. By far, the most important is, as you might imagine, a shipping business, which is defined as the operation of ships in international traffic from the transport of passengers or cargo, and lots of ancillary activities. And it's pretty safe to say that in most cases, if you own a ship, we'll get back to what exactly that means, and are operating the ship, you're probably engaged in, if you're a Marshall Islands entity, you're probably engaged in a shipping business. Just spending a minute on some of the other relevant activities. A holding company business is generally the business of being a pure equity holding company, just a company that receives dividends from its subsidiaries. A finance and leasing business is the business of providing credit facilities. Not a lot of definition of guidance as to what exactly that means, but generally speaking, you at least think about this anytime you derive interest income from loans or anything like that. I would just point out that despite the title, finance and leasing business, nothing in this definition indicates that there's an actual, that leasing is part of the definition. There's a distribution and service center business, which is defined to include, among other things, providing services to an entity in the same generally consolidated group of affiliated companies in connection with the business outside of the Marshall Islands. So generally speaking, if you're conducting intergroup services, you at least think about potentially this. And finally, there's a headquarters business, which is defined as the business of providing senior management, assumption or control of material risk for your group or related substantive advice. And it's worth noting there are various other categories. This isn't exhaustive. And each of these categories has lots of questions as to how exactly they apply. But this is intended as a very high level overview of what some of these relevant activities might be. It's also worth noting, if your business doesn't fall into any of these categories of relevant activities, if whatever your business is, it's not a relevant activity, essentially that means that it's the economic substance requirements do not apply to your company. And you could just say, I do not conduct a relevant activity, or more precisely, I do not earn income from a relevant activity, and therefore I comply and I don't need to do anything else. Okay, next slide. So I mentioned earlier about shipping business. I'm going to the second point first. Shipping business is interesting because you might think, obviously the topic of this webinar relates to shipping, and most Marshall Islands companies that are relevant to this conversation obviously are engaged in shipping in a broad sense. But the key point here is that the definition of a ship under the economic substance rules is really just a Marshall Islands flagship. So what that means is, in most cases, if you are engaged, if you own a Marshall Islands flagship and your entire fleet is Marshall Islands flagged, and you have Marshall Islands companies, you're probably engaged in a shipping business and you can be comfortable with that. If you don't, if you own have a Marshall Islands company, but your ships are have some other flag, then at least you have to think about those other relevant activities and how you might satisfy economic substance. I've said many times what it means to satisfy economic substance. The general rule is it's a three-pronged test to satisfy the economic substance requirements. A relevant entity must be directed and managed in the Marshall Islands, must have an adequate number of employees, physical present, and expenditures in the Marshall Islands, and carry out core income generating activities in the Marshall Islands. The theory behind all of this is, once again, if you want to say that you're a Marshall Islands company, that's fine, but you really need to have something that approaches true economic substance in the Marshall Islands, and not just a mailing address, a registered mailing address, and that's basically it. With that said, there are reduced requirements for shipping business, and for that matter for equity holding company business, that very generally say, as long as you comply with your IMO, ILO requirements, as long as you pay your fees, essentially as long as your company does all the things that it already has to be doing and should be doing, irrespective of the economic substance rules, that constitutes compliance with the economic substance requirements for purposes of a shipping business, and again, equity holding company business. And the theory, kind of similar to what Richard was saying, was shipping for over a century has been thought of as a business that is primarily conducted not in any jurisdiction. So it's not like a factory. Most income from shipping genuinely is earned on the open seas. And it doesn't make sense to say, well, we need to build this infrastructure in the Marshall Islands when your business is mostly earning income from transportation on the open seas. So as long as you fall into the shipping business, you generally don't have to worry about much else. Certainly you have to register your compliance. There are procedural things you have to do, but in most cases it's quite simple to comply with the economic substance requirements without anything else. The rest of my talk today is going to focus on what if you don't? What if you don't have a shipping business because you have non-Marshall Islands flag ships, and you might fall into one of those other categories of relevant activities? What happens then? And can you take the position, or what's at least the argument for saying that you are a tax resident of another country, and I'm going to be focusing on the US, and therefore are not required, and therefore your entity, because it's tax resident of the US and is managed outside of the Marshall Islands, it is not a relevant entity, and therefore is not required to comply with the economic substance requirements. Okay, next slide. So Marshall Islands tax residents, I've quoted verbatim the definition here. I'm not going to read the whole thing, but essentially it's if you are subject to the tax regime of another jurisdiction by reason of domicile, residence, or any other criteria of a similar nature, and then they talk about evidence. I am going to come back to this slide later, but I wanted to just set this out here as to what it means and what is the definition for tax residence. Next slide. All right, now I'm moving on to US tax residents. Obviously, there are something like 195 countries in the world. Every country has its own tax residence rules, but I am going to focus here on the US tax residence rules, both because the US economy is so big, there are so many US-based companies, but also the US rules are kind of confusing. And the first thing to note is there's no provision in the US tax code that says, this is a tax resident of the US. The closest thing I think you would say is code section 7701A30, which defines US person, which is often, but not always what we think of, kind of, as a tax resident. First of all, it's a US individual, citizen, or resident. And by the way, for individuals, there are very specific rules that define what is an individual residence. But of course, we're not talking about individuals here. We're talking about entities. You have the definition of a domestic corporation. Note, it doesn't say US resident corporation, but domestic corporation. And that is defined as a corporation organized under the laws of the US or any US state. And it's key to note, unlike many countries, the US for this purpose does not have a controlled and management test. Your company can be controlled and managed anywhere. It can conduct business anywhere. If it is organized in a US state, it is a US person. If it is organized outside the US, a US state, it is not a US person, or it is not a domestic corporation, and therefore for this purpose, it is not a US person. We also have the defined term domestic partnership. This is similar to domestic corporation, organized under the laws of a US state, except as provided in regulations. We don't really have regulations that override the general rule. There is, solely for purposes of interest sourcing, we have this defined term, which is a US resident partnership, means any partnership organized in the US or outside the US, if it's engaged in a US trade or business. That's potentially very broad, but what I would point out is that regulation, which is still technically in effect, has largely been superseded by changes in the code. And therefore, even though we have this defined term, resident partnership, the term is just not that relevant for most US tax purposes. So it's not a very helpful term. There are also rules about certain trusts and estates, but I'm not going to go into that. Next slide. So that was relatively unhelpful, I would say, in that it didn't really tell us what a US tax resident is. I think more helpful is what you might find in US income tax treaties or double taxation treaties. And here I'm focusing on the US model income tax treaty. Obviously, the US has lots of treaties with lots of different countries, but the current 2016 model treaty defines a tax resident as a person who is liable to tax therein by reason of his domicile, residence, citizenship, place of management, place of incorporation, or any other criterion of a similar nature. If you go back, I'm not going to do it now, but if you go back to that Marshall Islands definition, it was very similar to that treaty definition, and that's not a coincidence. But I would say of even more importance is what is not a resident. And specifically, we say the term U.S. tax resident or tax resident does not include any person whose tax is determined on a fixed fee, forfait, or similar basis. So if you have any sort of special deal, and very importantly, or who is liable to tax in respect only of income attributable to a permanent establishment. So, for example, if you have a non-U.S. company that has a U.S. permanent establishment through which it earns income, generally that under most treaties, income from that permanent establishment would still be subject to U.S. taxation. But with that said, the fact that you're subject to U.S. taxation on your permanent establishment income, that doesn't mean for this purpose that you're a U.S. tax resident. You really have to be essentially have all your income subject to U.S. taxation by reason of your domicile residence, etc. It's also worth noting, I've already spoken about partnerships, and I'm going to talk about partnerships and fiscally transparent entities more, but what does the concept of tax residence even mean in the context of a fiscally transparent entity? A fiscally transparent entity, by its nature, is just not subject to tax anywhere if it's fiscally transparent. What it means to be fiscally transparent is that it's the owners of this entity that are subject to tax. So what does it mean, for example, for a fiscally transparent partnership to be a tax resident? So what the rules say is an item of income, etc., that is derived by a fiscally transparent entity is considered to be derived by a resident, but only to the extent that the item is treated for purposes of taxation laws as the income of that resident. And this makes perfect sense. So, for example, if you have a Cayman partnership that is owned 50% by a US person, 50% by a non-US person, if that Cayman partnership's income is 50% is subject 50% tax, is subject 50% of that Cayman partnership's income is subject to US taxation, it's not even meaningful to say whether the Cayman company is a US tax resident or not. You would just say, well, we're going to focus on the owner. And of course, if the owner is a US tax resident, then to the extent that income is subject to tax, it's eligible for the benefits of the treaty. Okay, next slide. I'm going to talk a little bit about the US check the box rules. I've been speaking very generally about corporations and partnerships, but it's worth talking about what exactly I mean by corporations and partnerships. Under these 1996 rules, other than certain entities which are treated as per se corporations, and there's a large list of what are per se corporations, both US and non-US entities can literally check the box and they can elect their own US tax classification. Generally, there are three options for what tax classification you want. You can elect to be a corporation. A corporation is subject to full tax. It files its own tax returns on any relevant income and it pays any applicable taxes, and its members generally don't pay taxes. A partnership is fiscally transparent. So as I said earlier, any of its members will owe tax on their income derived by the partnership, whether or not that income is distributed up to them. But with that said, it is a real entity. It files U.S. tax returns to the extent it is obliged to do so, and sometimes it has withholding obligations. And it's worth noting that a partnership must have at least two members. And that brings us to the third category, disregarded entity. A disregarded entity is a fiscally transparent entity with a single member. So it's kind of like a partnership, except only with a single member. And unlike a partnership, it's fiscally transparent. Its member files any returns and pays any taxes in respect of any income earned through the disregarded entity. But unlike a partnership, it's almost not, it's for most purposes, it's not even treated as an entity. You just look through it and you just say its owner is treated as directly owning and filing, owning any income and filing any returns in respect of that income. Next slide, please. Okay, so tax residence of a corporation. In some ways, this seems to be a little bit simple. In most cases, we would think that a US domestic corporation, because it's subject to US taxation on 100% of its income, it probably is a US tax resident for treaty purposes, and for that matter, for Marshall Islands economic substance purposes. But of course, if it's a US domestic corporation, it's probably not subject to the economic substance rules at all. So why do we care? So then you say, okay, well, what about foreign corporations? And going back to some of those definitions that we had earlier about earning income through a permanent establishment. In most cases, a foreign corporation probably would not be treated as a US tax resident under applicable US tax treaties. But with that said, let's take a step back. We're applying Marshall Islands economic substance rules. Marshall Islands does not have an income tax treaty with the US. And the idea that we should be bound by US model tax treaties in interpreting for Marshall Islands purposes what is tax resident, you could certainly make the argument that Marshall Islands has its own rules and we're not bound by what the treaty says. Even further, you have the concept of freight tax. Very generally, there's a special rule, US tax rule on shipping income. Non-US corporations pay a 4% tax on US source gross transportation income. So could you say, on some respect, that just by paying this tax, this makes you a US tax resident? Again, under the US model treaty, almost certainly not, but under Marshall Islands rules, it's at least a question. Next. I think for fiscally transparent entities, it's even more complicated, as I was kind of getting at earlier with the treaty rules. So a foreign partnership will often have US tax return filing obligations. It will often file US tax returns. It will often report its income. Sometimes it has withholding tax obligations, and it will often have a US employer ID number, which is also a taxpayer ID number. And then you might say, again, let's say this is a foreign partnership that is owned by US partners. Well, in what percentage? Does this mean that if its income is subject to US taxation, should the partnership be treated as a US tax resident? And then what if it's 100%? What if it's 90%? What if it's 50%? We get into all these gray areas. There is a very special rule in the Marshall Islands guidelines that say a disregarded entity, not a partnership, but a disregarded entity, can say that it is essentially a tax resident if it produces a signed statement under penalties of perjury saying that all of its income has been included on the corporate tax return of the parent company. This is a very narrow exception. This basically means if you have a disregarded entity that is owned by a US corporation, then yes, that entity is a US tax resident. But next slide. But this begs the question, all right, what if you're owned by two US corporations? So once again, all of your income is subject to US taxation. Is it then a US tax resident? And then what if it's a disregarded entity owned by a US individual? Again, subject to full US taxation. So this is a question. We also have the concept of anti-deferral rules. You have various non-US corporations that are subject to that are controlled foreign corporations whose income is subject to current taxation by their US owners. If the point of all of this is to ensure that your income is subject to taxation and you can prove that it is in fact subject to taxation under these rules, could you at least argue that you are a Marshall Islands tax resident? Question. Next slide. All right, this is a repeat of a previous slide, but I just want to focus, I've now underlined some of the rules in the definition. So an entity is tax resident if it is subject to the tax regime of a jurisdiction by domicile, residence, or any other criteria of a similar nature. And there's no guidance as to what that means. And then it says the registrar will require evidence such as a tax identification number or assessment of or payment of a tax liability. Well, does that mean that providing that evidence is per se a conclusive evidence that you are a US tax resident? If so, that's a very low bar, because as I said earlier, many non-US companies that, at least under treaty rules, would not be considered US tax residents have a US taxpayer identification number. That's not hard. And also pay US taxation. For example, I alluded to the 4% freight tax. That's not hard. So we have more questions than answers here, but I just wanted to highlight some of the questions that go into the concept of tax resident for this purpose. Next. For my last slide, and we are running short on time, I just wanted to talk about what it means to have a Marshall Islands corporation. And here we really are talking about companies treated as corporations for U.S. tax purposes that may have U.S. boards, and there may be some planning opportunities. And the reason I'm focusing on this is many countries in the world have, once again, determined residence by control and management. The U.S. is not among them. So in most cases, if you have a U.S. board, in other words, a board of directors of your corporation, or for example, a board governing your LLC that's sitting in the U.S., in the shipping world, in most cases, you don't have to worry about U.S. taxation. And specifically, you don't usually worry about creating a permanent establishment, because those special freight tax rules under Section 87 essentially override all of the general rules about permanent establishment and effectively connected income. There are a few exceptions. Bareboat charter, if your business is bareboat charter, if you have a ferry and liner business, you have to at least think about this when you're selling a ship. And finally, if you're earning what is not strictly shipping income, and this is perhaps most relevant for cruise companies, which sometimes have onshore excursion income. But other than that, in most cases, you can be comfortable having a U.S. controlled and managed company, which is not a U.S. tax resident and which is not a U.S. tax resident and complies with applicable requirements. Thank you very much.
Well, thank you so much, Daniel. Meanwhile, you held your presentation, that popped in some questions into the Q&A tool. And one question has been raised by George Lemos, and it says, on what income base is the minimum tax rate of 15% meant to be levied? And that one is a really good one for Richard. So please go ahead.
Thanks, Verena. Thanks, George. Yes, it is a great question that has a super long answer, but I'll give you the very short one. The basic answer is that the income base is run off the accounts of the group. So you take the net income figure from the financial statements for the group. And interestingly, you're sort of getting in towards that. The idea of these whole rules is that there's a level playing field across the whole world, but they're implemented nationally. So there's absolutely scope for that income base to be different in different jurisdictions. But the starting point is the accounts for the parent company entity. And what you're doing each time, importantly for shipping, is you're trying to get to what they call your globe income. So you look at the income of the group, which is within these rules, and we call that globe income. And importantly for shipping, the idea of international shipping income is outside of globe income. So if you've got a pure shipping company that is in the exemption, its globe income will be zero. So its income base for these rules will be zero. And on a group level, you take out dividends. So a pure shipping group, you know, if we go back to my slide of the holding company and the operating company underneath, the dividend income is taken out of account and your international shipping income is taken out of account. You may well find that your globe income is zero, so there's nothing to pay a top-up tax on. But the basic answer to your question, George, is it's the accounts of the group, which is your starting point each time.
Okay, very good. And then we have, I think, 2 questions regarding Marshall Islands. So, Daniel, do you want to take on these, please?
Sure. So Tassos Tsimplakis asks, does falling under the scope of a relevant activity mean that the entity in concern is considered as a tax resident in Marshall Islands? And then follow up, and in the contrary, declaring that an entity does not perform a relevant activity, does it mean that the entity is certainly not a Marshall Islands tax resident? So the answer to this question, well, the first question is definitely not. Regardless of whether you are conducting a relevant activity, this entity, a Marshall Islands entity, generally will not be considered a Marshall Islands tax resident unless it has an actual on-the-ground business in the Marshall Islands. And this is important, and often people will kind of assume that because you have a Marshall Islands entity and even a Marshall Islands domestic entity, you'll say, well, I'm a Marshall Islands tax resident, but under Marshall Islands tax residence rules, that's just not right. So almost every shipping company certainly every Marshall Islands shipping company that I've ever encountered is not a Marshall Islands tax resident, and merely conducting a relevant activity, whether shipping business or any other, does not make you a Marshall Islands tax resident. According to the Marshall Islands ESR, can an entity be subject to more than one tax regime or be simultaneously tax resident in 2 different jurisdictions? So the way you comply with the economic substance requirements is through a portal. On that portal, you would only put one tax resident. Hypothetically, you could be dual tax resident or tax resident of multiple jurisdictions, but all you need is one. So you could pick whichever one if you were legitimately a tax resident of another country and just say I'm a tax resident of one and just put that.
Okay, very good. Well, very interesting. I mean, that's on the Q&A session. I think we are running out of time already, so it's 5 after 2. I mean, needless to say, from all of us, many thanks to all the participants for joining us today in this session. Also, of course, special thanks to our speakers, Daniel and Richard. Of course, that was very, very interesting, and as always, we didn't have the time to go in all the details. And of course, if you have any follow-up questions, anything you want to discuss or know on that, please feel free to get in contact with any of the 3 of us. We will be very happy to answer any questions you may have afterwards. Thank you so much for joining us today. Have a good day.